The Bank of Canada has cut their policy interest rate by almost 3 full percent, and yet sales remain near all-time low levels. Why is that exactly? Hello, everybody, and welcome back to the Last Honest Realtor podcast. I'm your host, David Fleming. Thank you for joining me today as we ask and attempt to answer that question: why are lower interest rates not motivating buyers? Now, throughout the course of 2025, whether it's on the Last Honest Realtor or on Toronto Realty blog, I have been talking about sales. People seem to be so interested in prices, but what's really interesting me are sales, or rather lack thereof. You might have seen last week's podcast or listened to it. I mentioned, among other things, that sales are not just going to set a new record low, but absolutely obliterate the previous record. So I'm a bit of a stats nerd, whether it's sports, whether it's real estate. I love looking at things like dynasties, things like records. I found it to be tremendously interesting and exciting to look at the dismal sales from 2023. Coming off of a peak in 2021 where we saw 121,000 sales, that was almost cut in half, down to 66,000 and change in 2023. Now in 2024, second worst year for sales ever. And by the way, for context, by ever, I'm looking post year 2000, because who cares what sales were like in 1995 when the city was half the size. Now, we saw about 67,000 sales in 2024. We are on pace right now, folks, for under 59,000 sales. Why is that? And especially, I ask, why is that when we've seen the Bank of Canada policy rate reduced from 5% down to where it currently sits at 2.25%? Now, not helping matters, listings are at an all-time high. We talk about new listings and we talk about active listings. And this year, active listings have been all the story, because 20,000 active listings in a month, that was always my metric. And we went, I believe it was 5 full years without seeing a month with 20,000 plus active listings until 2024, when we saw 8 months in a row with over 20,000 active listings. Not to be outdone, the year 2025, we saw over 30,000 active listings for the first time ever, and we've seen it 4 times to this point. Now, while all this is happening, interest rates are declining. Why are we not seeing more sales? Why are lower interest rates not motivating buyers? Now, I am going to give you a lot of thoughts on that, but first I want to start with a story. It's an anecdote, it's a metaphor, it's a fun one, it's a bit verbose, as I am, and it's going to date me. Now, I started in real estate in 2004, and around that time I decided to try to chat and learn from and network with some older folks that maybe had a little bit more experience, not just in business, but in the ways of the world. Now, a friend of a friend said, meet me downtown for lunch, and I did, and I went to this magical underground labyrinth called The Path. I had actually never heard of it. I didn't know that there was an entire city underground where people go and never see the light of day, and they can just zigzag, and you can do your grocery shopping. I mean, you can get your hair cut. You can do a lot of things down there, and you can have a really poor meal of food in a giant cafeteria when you're not going to, I'm going to date myself, Jump, Vertical, Earls. Those were the big banker bars back in the day. So I'm sitting with this gentleman who's older, he's established, he's very successful, and I'm learning from him, and he's giving me some wisdom, some advice, the ways of the world, and asking these open-ended questions. Now, one of the questions he asked, which was absolutely fascinating, and it is the story of today's podcast: what price would you put on, I'll stop and pick that up off the ground? Now, I wasn't entirely sure what he meant by that, and he clarified by asking, what type of coin would you actually bend over and pick up? He explained that everybody has a price at which they would stop, bend over, and pick up a coin. And he said, it's different for everybody. What's your price? Now, he explained with his hands as he named every coin. He said, would you pick up a penny? Would you pick up a quarter? Would you pick up a loonie? And of course, I'm a visual thinker. So I started to go through these coins in my mind, and I pictured an ugly brown copper penny sitting in a puddle in the middle of the intersection. I thought I wouldn't stop and pick that up, and my mind moved on to a nickel. As a child, it was the thickest coin. It had a beaver on it. I remember my mother used to give me nickels at the Leaside Arena. You put it in the vending machine, and it would spit out a gumball. But I probably wouldn't pick up a nickel because it's only 5 cents. And so moving throughout the rest of the currency, I mean, a dime, it's the thinnest, it's the smallest, but I kind of pictured a dime like stuck to the sidewalk, and you bend over and you're trying to scrape it up, and no, I wouldn't. But then I thought, the quarter. And yes, my mind goes back to childhood, I'm sorry, but for many people it does. And I thought, a quarter, I mean, man, 1987, that bought a pack of baseball cards. In fact, throughout childhood, a quarter got you 5 5-cent candies. Yes, thank you for the math lesson, David. But remember Hot Lips? Get 5 of those for a quarter. Remember Big Feet? You get 5 of those for a quarter. And here I am in 2004, sitting in this underground labyrinth called the Path, talking to this guy who's trying to prove some sort of point. And I said I would stop and I would pick up a quarter. That's my price. So I waited for some sort of revelation, and he just sat there taking a sip of his water. And I said, so what does this mean exactly? And he said, well, I don't know. You tell me. And I said, but it's your metaphor. I believe that you are supposed to give me some sort of takeaway. And he eventually explained that, well, he could tell me what the riddle meant to him and what could be learned or how this metaphor could be extrapolated into real life. The exercise would be 1,000 times more beneficial if I took some time to reflect on this on my own. Now, I'm going to come back to that. And if you want the conclusion, well, you're going to have to listen to the next 10 or 15 minutes. But this, to me, is one of those lessons learned or one of those metaphors explained, one of those adages, those idioms, those lines that just sticks with you for the rest of your life. So another history lesson. This one is more related to real estate. Historically, smart money gets out ahead of interest rate cuts. And what I mean by that is, let's liken this to, say, a share of stock and they're about to release earnings, or maybe it's a biotech company that's going to give you the results of their latest clinical trial. The smart money gets out ahead of that. And as far as the real estate market goes, smart money has always got out ahead of rate cuts. I would say that this is probably 10% of the buyer pool, 10% of the market. And sorry to say, but in any asset class, that's usually, or you might argue it's 99% and 1%. But who are the ones making the money? Who are the ones outperforming the market? And who's everybody else? Now that's the herd mentality. Do what everyone else is doing, fall in line. The contrarians do it differently. They buy ahead of the rate cuts. Now in 2024, I thought that the market would absolutely pop, and I was wrong. I thought the smart money would represent the front runners. People would get out ahead of the interest rate cuts, and it didn't happen. And it might be the first time in a long time that more buyers did not get out ahead of rate cuts. Now, to refresh on interest rates just for a moment, and there are folks that are listening to this and they can tell us about interest rates in the 1980s. Okay, yeah, we've heard that. And a lot of the people, and I actually don't know what the demographic of viewer of Last Honest Realtor is. I think I probably have a mix of younger folks that really don't know or don't care, and a mix of older folks that can absolutely explain what it was like with 22% interest. But for our intents and purposes today, let's just go back a decade. November of 2015, 10 years ago, the Bank of Canada rate was at 0.5%. Now, that's a pittance compared to yesteryear. But for context, it remained there until June of 2017. Now, back in 2015, 2016, 2017, yes, the market was quite busy. It was not quite 2021, 22 levels, but it was certainly busier than the years, say, 04 to 08 when I was in the business, or after the slowdown in 08, from basically 09 through the very simple, the very basic, the very standard years of 10, 11, 12, 13, 14, 15. They were always a seller's market. They were always increasing, but not with the level of volatility that we had grown accustomed to seeing years later. Now, September of 2017, the rate increased to 1%. In 2018, in January, 1.25. 1.5% in July of 2018, 1.75% in October of 2018. Now, this is important because 2018 is, well, this is a year and a half before what changed the world, the pandemic, and changed the course of the real estate market in Toronto forever. Now at 1.75%, this is slightly below what the government calls interest rate neutral territory. And I don't want to give a long economics lesson here, but just consider what interest rate neutral territory is. It's a theoretical real interest rate at which the economy is at its potential output with stable inflation, meaning monetary policy is neither stimulating nor restricting growth. And for those of you, and this is years ago, I did an economics degree in the 90s, and we learn about fiscal and monetary policy, and we understand the role of the central bank to tighten things when needed, and of course to, release the elastic band on the waist, so to speak, when also needed. They can motivate and stimulate the economy, and they can restrict it depending on where the economy is going. Now, this is why we hear so much about inflation. Inflation was just the most boring thing. Inflation, interest rates, throw in unemployment, the statistics that dominated the conversation in 2023 and 2024. But the central bank needs to find what people often refer to as the Goldilocks rate, which is just right for the economy. You want to allow for steady growth without causing inflation to accelerate. Now, the impact on interest rate policy. If the current interest rate is above the neutral rate, monetary policy is considered restrictive, designed to cool down the economy and fight inflation. And of course, that is what we had after the pandemic when inflation, I think it topped out over 8% in, I want to say, May of 2022. 8.7, just off the top of my head. Now, on the other side of things, if the current interest rate is below the neutral rate, monetary policy is considered stimulative, designed to boost economic growth. I remember grade 12, now I'm really going to date myself, grade 12 exam, remember foolscap? Okay, it was like that longer paper, and I used to write with a pencil in exams, and I wrote this massive long thing about fiscal monetary policy, the role of the government to, in times of economic output, okay, let's slash the interest rate, let's make it low, let's get people to borrow money. People are going to start businesses, people are going to buy, they're going to put money out there, they're going to stimulate the economy. But what happens when that backfires? What happens when there's too much money out there? What happens when too many people are going and buying flat screen TVs? Obviously, in the 90s, I wasn't writing about flat screen TVs in the grade 12 economics exam. But that is the role of the central bank. That is what they have to monitor. And that takes us back to October of 2018, when the rate is at 1.75%. What happened after that? The rate remained at 1.75% through the end of 2018, through all of 2019, and into 2020. March 4th, 2020. Pandemic, right? And I believe it was March 16th when the entire world shut down, because as I will always remember, the night before on March 15th, I had 13 offers on a condo in Regent Park. We listed for $499, we sold for $625. The next day, the world literally ended. This was also a month after my second child was born. Good times. So on March 4, 2020, the Bank of Canada reduces the key lending rate from 1.75 to 1.25. 7 days later, 7 days. And keep in mind, the Bank of Canada makes, I believe it's 9 announcements per year, 9 announcements, and they always give you those dates in advance. So right now in November of 2025, we already know all the dates when they're going to make their announcements in 2026. But this was, oh God, what were the lines during the pandemic? These unprecedented times. So March 13, 2020, they slashed the rate from 1.25 to 0.75. And then 14 days later, they reduced the rate from 0.75 to 0.25. 0.25%. Now, remember when I came into this, I told you that the rate in November of 2015 was at 0.5%. That's the lowest, since I was in real estate. I got into it in 2004. 0.5% is absolutely maddening. But they're doing that to stimulate the economy. Because as I've said, interest rate neutral territory is, 2%? I mean, every central bank has a target for inflation of around 2%. We hear this all the time. You don't want it to be at 0.25%. I mean, inflation on a long-term basis, this much inflation is a good thing. That's what you need, right? You don't want deflation. You don't want stagflation, anything ending with inflation, obviously. But you also don't want 8.7% inflation. So if you're trying to keep inflation around 2%, and I don't want to get into the idea of interest rate neutral and then the real interest rate, right? Which is you're supposed to take the net neutral interest rate and add it to inflation. That comes up with your interest rate policy, topic for another day. But when we hit 0.25% in 2020, it changed the economy forever. It changed the real estate market forever. And as we sit here 5 years later, 5.5 years later, everything that we know and all of the questions that we're trying to answer can be drawn back to that experience. We had 2 full years at 0.25%. Now, what else happened during this time? During the pandemic, everybody wanted to move. People that were in rentals wanted to buy. People that were in condos wanted houses. People in houses wanted condos. People that were in Toronto wanted to move out of Toronto. And people that were out of Toronto wanted to move into Toronto. And I have all kinds of stories, and I don't want to betray any confidences here, but I had a set of clients that were living in an absolutely gorgeous loft, but it had no windows that opened. The pandemic did a lot of things to a lot of people. I mean, I don't want to be that guy, but there are folks walking down the street in November of 2025 wearing masks. To each their own, but the pandemic did a lot of things. And I had these folks that were living in this box, and they said, we need out. And they bought a house because they couldn't live in their condo with no opening windows anymore. I had folks that were working from home and just ready to go nuts. And they said, we need a bigger place. I had folks that were living in the city and they said, we can't be here anymore. And they moved out of the city because they were working from home. And topic for another day, but what happens when everyone needs to come back? So with a 0.25% interest rate and with this pandemic upon us, everybody started moving. And that is why we saw in 2021, 121,000 sales. So I'll save you the increase schedule here. We'll touch on it a little bit. But we saw 10 interest rate increases starting March 2nd, 2022, when we went from that 0.25% rate. And history shows that people on variable rate mortgages got absolutely crushed. There were people whose mortgages doubled. Now, the mortgage renewal cliff, okay, I was one of the first people, if I could toot my own horn just for a second. And it wasn't like I was in denial trying to sell real estate and say everything's fine here. I think I've done a pretty good job on this podcast, on the blog, of showing you that, I'm not the cheerleader, but I absolutely did not believe in this mortgage rate renewal cliff. It was completely debunked. We talked about this. I started writing about this in 2023, saying how this is not really going to be a thing. And yes, people started paying a lot more for mortgages, but it wasn't as bad as a lot of economists made it out to be. Now, real estate prices peaked in the spring of 2022. They started to decline. The home price index has been declining steadily since. But when you take this interest rate of 0.25% and you add 10 straight increases, we end up getting to 5%. So from March 2nd, 2022 through July 12th, 2023, we went from 0.25 to 5.0. So that catches us up to the peak. And what happened during that time was the market just kind of stopped. Now, as I mentioned, the sales hit the low in 2023. They didn't really do much more in 2024. But the question becomes, why? Why did people stop transacting? Affordability is part of it. But if prices are coming down, then it's more affordable. So if you have an interest rate that absolutely skyrockets and, okay, well, the affordability, it's just not there anymore. People stop buying. But when things start to come down, both in terms of price and in terms of rate, you would think people are going to start to buy. And that is this question that I want to answer today. Now, we get our first rate cut, June 5th, 2024. 25 basis points from 5% to 4.75. It's not going to move the needle. This is the very end of the spring market. But as I said, I would have thought people would get out ahead of it, get out ahead of the rate cuts. That's what smart money's always done in real estate and in other markets. Now we get a couple more cuts. And on September 4th, 2024, which is right at the start, God, I remember this like it was yesterday. Holy moly, the last year's gone by quickly. September 4th, this is perfect. We just got a rate cut. At the beginning of the fall market, this is going to move the market. And it doesn't at all. Now we get a jumbo cut, as they call it, October 24th, 2024, 50 basis points. We're back down to 3.75. And then on December 11th, we get another jumbo cut, and we're down to 3.25% by end of 2024. Now, January and March of 2025, we get two cuts of 25 points each. And as Seinfeld would say, yada, 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 two more cuts in September, October of 2025, and we're sitting at 2.25%. The next announcement is December 11th, and is widely expected we'll see another 25 basis points cut. Folks, we will be down to a 2% rate by the end of this year from 5%. Why are more people not buying? Okay, so let's pick up our story where we left off. About a week after I meet this older gentleman who I'm asking for advice and wisdom and to regale me in ways of the business world, I end up running into him at the friend of a friend. It's Sunday, we're watching football. I think we went in the kitchen at the same time to grab a beer maybe, and it's just the two of us. And I said, I've been thinking about this riddle that you've asked me for the last week. And he says, okay, I'm all ears. He folds his arms across his chest, leans on the kitchen counter, and says, explain. Now, this is 2004. As it was back then, and as it is now, there is no right or wrong answer to this riddle. Everybody is different. Everybody has a different set of values. Everybody would value this, that, or the other thing differently. People come from different walks of life. People come from different backgrounds, different social circles, and different economic statuses. The metaphor itself could dictate that if one person says, I'll stop to pick up a dime, but the person next to them says, I'm only going to stop to pick up a loonie, that person mathematically has to have a net worth of 10 times as much. Now, that could be true, but that's taking everything at face value. That's simply math, and nothing in life is that simple. What about a difference in priorities? What about a difference in life cycle? What about stopping to pick up that coin on a sunny day versus a rainy one? Now, what I learned from this experience is that everything is relative in life, in business, in economics, in personal finance, and to take this a step further, in health and happiness, right? There's that old adage, why is it that the guy that had absolutely everything wasn't happy? It can't just be boiled down to simple math. There are all kinds of different variables. And you've heard the expression, one man's trash is another man's treasure. But by the same token, I would say that one man's lottery winnings is another man's cab fare. So what in the world does this have to do with real estate? History's shown us, and with the advantage of hindsight, a lot of people really benefited from that central interest rate of 0.25% years ago. And now, while this was completely in response to the pandemic, as I've said, it changed the course of economics in this country and real estate forever. Now, relatively speaking, and there's that word again, relatively speaking, that 1.75% rate that we saw pre-pandemic, that was near all-time lows for folks that saw interest rates in the 1980s. But relatively speaking, for the folks that watched others around them buy during the pandemic and get 5-year fixed rates of 1.59%, they couldn't fathom an interest rate of 4.79%, even after interest rates had come down. So my analogy, guys, and I hope you took something away from that. I hope that the presentation of the analogy was apt and easily absorbed. But that's something that I've always held on to. And there's another saying, and this is one my wife's uncle has. Not everything has to make perfect economic sense. And what he means by that is that, let's say someone writes you a check for $100. Now, you got to put that check in the bank today, because if you wait a week, you're losing out on interest. But who cares? I mean, what's the bank rate? Like 1.5%? You're literally talking pennies. Now, if the check is for $1 billion and you're running a hedge fund or you're in wealth management, well, it's certainly not pennies anymore. But that's where I get into everything is relative. And that's where I get into what my wife's uncle would say is that not everything has to make perfect economic sense. Because in this analogy of at what price would you bend over to pick up a coin, you see where I'm going with this. At what price would you get into the market? When rates were at 5%, they came down to 4.5 to 4. Some people got in, most didn't. It just wasn't worth it. Now, if you were to couple the decline in home prices with the decline in interest rates, it doubles the affordability. But people still didn't get into it. They don't want to bend over and pick up a penny. They don't want to pick up a nickel. A toonie, they might. And that's where this metaphor can be applied to our real estate market, because the premium for someone to stop, bend over, and pick up the coin, or in this case, get into the real estate market, is still not attractive enough. Now, I have a theory, and I've shared this multiple times throughout the year. It simply goes like this. Buyers want to buy on the way back up, even if it costs them. Now, there's that expression, no one wants to catch a falling knife, and people that use it, most of them don't really even know what it means. As the market is going down, when are you going to grab and catch that thing? And is it going to go down further? Now, another thing that I have said over and over, this example of buyers buying on the way back up, is that if you were to liken this to a fictional share of stock or anything traded, let's say it's at $100, it goes down to 95 and then to 90 and then to 85 and then to 80 and then to 75. You have the opportunity to buy it at 75, but you're worried it's going to go down further. So you don't. And guess what? It goes down further to 70. And you say, thank goodness I didn't buy. Starts trading at 72, 75, 77. And you're like, yeah, it's fine, whatever. Starts trading at 80 and 82 and 84. Maybe it's a dead cat bounce. Maybe I should wait a little bit longer. I would say that that fictional buyer jumps in at 91. But guess what? They got a deal because it was trading at 100. And this is where it's human nature to condition ourselves to be right. we can always tell ourselves it was the right call. In that example, that individual could have bought at 75 and made the decision not to, and then bought at 91 on the way back up. And when this share of stock or this fictional asset ends up over $100 again, and we're now on the way back up and everything's gravy, because I mean, you're aware that every single real estate decline has eventually been surpassed. That's the way the market works. At that point, that person can say, you know, I bought in at 91. Oh my gosh, really? We're trading at 110 and the previous peak was 100. God, you're smart. You got it at 91. But you made a conscious decision not to get in at 75. This is human nature. People do not want to buy on the way down. They want to buy on the way back up, even if it costs them. And what we're seeing right now is there are a lot of reasons for buyers not getting into the market. Now, the number one reason is that the market could go down more. Yeah, absolutely it could. I mean, hey, I bought 2 condos in 2024 because I could not believe the prices. Guys, they're worth less today than when I bought them. Now, both of them were super deals. Oh, wait, what did I say there? They can always convince themselves it was the right call. No, but I'm different, right? Yeah, I bought 2 condos last year. And 20 years from now, I'll be like, wow, I can't believe that. But I bought on the way down. I'm not going to buy on the way back up. And I'm living proof of it, folks. And I'm going to add one more before the year is out. Because sidebar, 2 weeks before Christmas, there's going to be a lot of people that want to sell. Now, the market could go down, yes. And then there's this catch-all. There's a reason to be afraid. Economic uncertainty, Trump, tariffs. Oh my God, what's happening? That is the best reason in the world for you to just do absolutely nothing and then tell yourself that you were right. You just want to hide. You want to ignore the world. And we're being bombarded with media negativity. And don't forget, when the market was ripping, the Toronto Lifes of the world and all of these media enterprises, they loved the stories about, you know, the letters from the buyers and multiple offers, or the buyer that's bribing the seller with leaf tickets. When we're in boom times, these stories are exacerbated for the better. And when times of decline, these stories are exacerbated for the worse. Now, the number one reason I would say why people aren't getting into the market is they're afraid it will go down more. The number 2 reason, or call it 1A, it's greed. It's want. And this is just human nature. And I'm not sorry. If you were to go back to caveman times, I'm sure there's a caveman that had absolutely everything that he needed. But you don't think if he saw somebody else, he was going to club him over the head and take it? That's just human nature. And for this, I'm going to go back to another story from my formative years, which I do a lot. When you're at a casino, when do you take your chips off the table? Now, I remember this one time. I think I was 21 or 22. My little brother would have been 19 or 20, never been to a casino in his life. And we went to Niagara with my university buddies, and he tagged along. And we went to blackjack, and there was 1 seat. I said, you know what, Neil, you go ahead. It's totally cool. And keep in mind, this is like 2002. So these dollar figures are going to seem quite paltry. But I think he put down, you know, what, 30, 40, 50 bucks on the table and started playing. Now, this magical thing happened. And I can't remember the exact hands. But I think he splits 2 cards and then splits again. And the dealer's got a bust card, so doubles on all of them. Dealer busts and he wins 6 hands at once. Like, this is big money to university students. The very next hand is a blackjack. And then the hand after is another blackjack. And I grabbed my brother by the collar and I said, we're done. And he said, what do you mean? I was like, we're done. We're leaving. He's like, but. I said, Neil, we got 150 bucks here. We're going to go sit at the bar, order some fries, get some nachos, and we're going to watch the Leafs. Now, this is in 2002 when people actually cared about the Leafs. That's a topic for another day, but I do not care. I was going to sidebar there, but I won't. And so the point is, all of my buddies went and got absolutely rinsed. They played all night because that's just what people do. Now, I'm not tooting my own horn here because as kids, me and my brother were able to get $130 off of a blackjack table. But the point is, what we did there is impossible to do. And at the end of the night, my brother was like, yeah, you're totally right. We ate and drank for free. And he got to play a little bit because it's a game. It's, you know, supposed to be fun. Now, that is a microcosm of what's happening out there in the market right now. People don't want to take their chips off the table. Do you like math? Good. Let's say you're buying for $1 million. At a 5.95% interest rate, your monthly payment is $4,733. $838 is principal and $3,896 is interest. Now let's say that after 225 basis points are cut by the government, you're now at a 3.7% rate. Your mortgage payment goes from $47.33 to $36.91. That's $1,041 lower per month, just based on the government changing the policy rate. Now your principal repayment increases $394 a month, but the interest you're paying is $1,436 lower per month. Why are these folks not taking their proverbial chips off of the table? Prices are down, rates are down, affordability's increased, monthly payments are down, and people are still waiting. And I give you those examples. Me and my brother playing blackjack, and all my buddies. There's actually the two guys, and young men can understand this, and older guys that have been through this can understand. Remember the two buddies that wanted to go to the high rollers room? And then they literally leave, like they gave their pants to the, like they just have nothing left. I remember my two buddies, I don't know them now, this is 20 years later, go to the high rollers room. We're going to the high rollers, yeah, cool man. You're going to take down the casino. You two guys are going to take it down. Anyways, just an aside, some people can relate to that. But that's my metaphor. And then the other one where we came into this is the idea that everyone has a price at which they would bend up over and pick up a coin. Now, what I'm seeing out there right now is there's these different buyers that could get into the market and aren't. Now, the first-time condo buyer, and far be it for me to say, yeah, my first condo was $277,000. So I'm going to throw numbers out there that aren't even close to that. Mind you, that was 2005. And people are going to say, well, it's still too expensive. But if you're the first-time condo buyer that could pick up a unit right now that was trading for $700,000 at the peak, and you can get that for $550, take your chips off the blackjack table, right? Bend over and pick up that toonie. You don't want to pick up the nickel? Fine. But the reasons for that, as I've explained throughout the year, is, well, fear of it going down lower. That 550 condo is going to be worth 540. It's also the idea that, well, maybe I could get more money if I waited longer. Would you give up the 150,000 because eventually the market does come back to maybe get another 20? And if the market does turn around and start going back up, as I use in my other analogy, when are you going to grab onto that? Now, the first-time entry-level home buyer, and during the RIP in 2021 and 2022, there wasn't a better listing as an agent to have than that $1.3 million house that you listed for $999 and got 17 offers on and sold it for $1,375,000, which is more than the intrinsic value. Those houses right now are in abundance. And we do hear, a colleague of mine last night, she had 3 offers on a listing. That's great. I sold a house, and the agent that provided the buyer, they were really nervous about their Leslieville listing. You know what? They got 4 offers and they sold it. But for every one of those stories, there's 20 houses that don't sell on the offer night. And if you're an entry-level buyer and you can go in and get what was a 1.4 house now for 1.2, what are you waiting for? It's going to cost you less to buy it, and it's going to cost you less to carry it because the rates are lower. And people watching this, quick, go to the YouTube comment section. Listen to this guy. Doesn't he know that house is going to go down to 400,000? I know, and you're going to be there to pick it up. I've been hearing this since 2004 when I got into the business. Now, the move-up buyer. Here's the one buyer. I talked about the smart money. Here's the one buyer that I find is making this transition. They own a $1.5 million semi. They want to go to a $3 million detached in another area. Those are the folks that are doing it. Now, I personally think that the $3 million house in selected areas, that market is flat. It might even be increasing. Prices are decreasing, but that's recession proof because there are a lot more people that want them than properties that exist. But I would also say that those folks realize that in a down market, when you buy and sell in the same market, you can't get hurt. But if you're buying something that costs twice as much than what you're selling, and if the market moves in equilibrium, you might be down 150,000 on your house, but the math says they're down 300,000 on that house. And that is the one type of buyer I find in this market that is starting to pick up the pace. Now, the expression fortune favors the bold, it's a good one. But what if everybody is being bold in the exact same way? Doesn't really make it bold anymore. The buyers have been on the sidelines. The buyers have been waiting. They've been watching prices decline. They've been watching interest rates come down, and they are the bold, but they're all doing it. And eventually this market is going to turn around. Personally, I think it's going to be late spring 2026. Go to YouTube comments section. Tell me I'm full of it. That's fine. I'm ready for it. It'll have been 4 years since the peak. Our peak was in Feb of 2022. 4 years later, prices have adjusted. Interest rates shot up, came back down. And look at what's happening in the housing market. Nothing is being built. So the turnaround, hey, it could be 2027. But I think eventually, as we've discussed today, people are going to start to realize it's time to take the proverbial chips off the table. It's time to bend over and pick up the free money. And I think we're going to see that start happening in the spring of 2026. Well, I enjoyed that. I hope that you did. And I enjoyed it just because I got to think about all my formative years, which is where all my stories have come from. You don't really hear me telling a lot of stories about a year and a half ago because it's not as fun as it was when you were in your 20s. Yeah, well, listen, excuse the analogies, guys, or don't, because I think that they were somewhat apt. And you can feel free to steal that one, the what price would you bend over and pick up a coin, because it's a good one. And that was 21, 22 years ago, and it's stuck with me to this day. So much so that I got to put it in this episode of The Last Honest Realtor. So folks, thank you so much for watching. As always, wherever you get your podcasts, please remember to like, comment, and subscribe. If you are watching on YouTube, drop me a line. Tell me that the market's going to drop by 75%. Tell me that I'm just a real estate agent that's just trying to sell nonsense. And don't forget to explain exactly why. A comment without justification just doesn't hold the same weight. And as always, folks, thank you for watching. We'll see you here next time on The Last Honest Realtor.